Okay guys, so welcome to today's video where I'm going to talk to you guys about fundamental analysis and just how I now personally use fundamentals to trade the markets, and how when I first started trading back in 2014, I was around 24, 25, I was only using technical analysis, only using chart patterns. I never understood why markets are moving, as I'm sure you're probably in the same position right now if you're feeling very confused. I never understood the factors that drive the currency markets, like interest rates, like inflation, and I just found it extremely frustrating that the markets would move one way one day and then completely opposite move the next day, and I never understood how to really look at the bigger picture to see where is the market trending and fundamentally what is driving the markets. And I remember when I was around 27, I started to read Bloomberg every day, which is a ritual now that I follow. I read like 20 articles a day. And I remember when I was looking at the articles online and I was listening to the investment bankers that you'll see on Bloomberg TV, and they interview hedge fund managers, none of them was talking about chart patterns. None of them. They was all talking about where interest rates are going. They was all talking about where inflation is going. They was all talking about what central banks were doing. And that's when it started to dawn on me. I was like, why are all these billionaire people not saying anything about chart patterns? Then I found a course online from an investment banker. That's when it was like a light bulb went off in my mind, and I was like, this is how professionals are trading. And when I took the course, everything was fundamentals. 80% of what they do was based on what's happening fundamentally. So looking at like economic data, where is inflation going, where is interest rates going, which is literally driving the currency markets and the stock markets, because the price of money affects the demand for a currency, because what's happening in the bond market, like how demanded are a country's bonds based on the interest rate relative to another country. And in today's video, I'm literally going to break down for you guys why the euro is so weak against the dollar in 2022 and in 2021, because the US has been raising interest rates at a faster pace than Europe. Why the pound is getting plummeted against the dollar right now, because again, interest rates in the United States are going up at a faster pace than the UK. And the same thing is happening in Japan, where interest rates are remaining very low because Japan's had a deflation problem for like 30 years, and the US interest rates are going up at a much faster pace. The US has gone up 25% in 8 months against the Japanese yen, literally because of interest rate differentials. If you go online and you type in why is the yen so weak against the dollar, it's all to do with interest rates in the government bond market. So I really want to just show you guys how to fundamentally start to build an understanding about why the currency markets are moving, because it will shift you from focusing on technical analysis, chart patterns, to actually asking the question, okay, the market's moving in this way, but why is it moving in that way? Because if you can understand why, then you'll be able to get into a trending market early and make a lot more money than trying to day trade and get in and out of the markets, which I know for you is being frustratingly inconsistent, because I've been there myself personally, okay? So I just want to share with you guys what I understand and how it's really helped me, and hopefully how it can really help you guys understand the markets as well. I will also talk about the Australian dollar, why it's so weak against the US dollar because of iron ore prices, and that's based on what's happening in China. So you're going to start to understand global trade, how that affects currencies. And again, I just want to help you guys understand what is going on in the currency markets. So guys, if you find this video has really helped you, please leave a comment. Let me know how you're trading yourself personally. Like, comment, and subscribe. And then also guys, you can come and join my Telegram channel, where I'm literally giving video updates on the markets every day, live trading sessions, doing some webinars as well, for free in this channel. And then if you wanted to come and join my full-time membership service, you're more than welcome. But primarily, I just hope you enjoyed this video. Okay guys, so let's have a look at fundamentally what is driving the markets in 2022. Why is the dollar so strong? And hopefully this can help you guys. Thank you. Okay guys, so we're going to have a look at the US dollar and why the currency is so bullish at this moment in time against the euro, against the pound, against the yen, against the Aussie dollar, New Zealand dollar. I'm going to break down some key fundamentals, especially with the energy crisis in Europe. We've had China slowing dramatically, weakening the New Zealand dollar and the Aussie dollar. And as the US interest rates outpace Europe, the UK and other countries, and the real inflation adjusted interest rate turns more positive in the US, the dollar is in demand, okay? So we know in Europe there's an energy crisis, okay? Russia has cut off gas supplies to Europe, and Europe is completely reliant on gas supplies from Russia for energy, because gas creates electricity. So they're saying Europe is going to have to ration energy through the winter months, and if they cannot replace the oil that Russia has cut off from Europe with liquefied natural gas imports, that's even more damaging because they may be forced to have blackouts where basically manufacturing companies can't manufacture goods quick enough, services business may have to turn off the lights, and it will basically cause a contraction in growth in Europe. Okay, that's why at this moment in time the German stock market is falling, as we can clearly see, aggressively. So is the European stock market falling at the same time, and investors are taking their money out of Europe and they're moving it into the United States because the European Central Bank is in a very difficult situation. Yes, the European Central Bank is going to raise interest rates, which would usually support the currency to strengthen, but in Europe it's a very, very different situation to the US because Europe relies on energy imports from Russia. So energy, you can see, has gone from 5% at the beginning of the year up to 9.1%. Inflation keeps going higher. If you strip out food and energy prices, core inflation is half of what headline inflation is. So you can clearly see that the inflation is being driven just by energy and not by strong consumer spending. And by the way, the core inflation number is still being affected by the supply issues caused by COVID, because China right now is locking down 21 million residents in one of its biggest manufacturing cities, and China is the manufacturing capital of the world and so is Asia. And remember, they're still having COVID problems, so the West can't manufacture their goods in the developing countries in Asia like they usually would. So there's a supply and demand imbalance because people coming out of the pandemic had a lot of savings, they were spending a lot of money, and the demand for goods was outweighing supply. So you have supply issues causing core inflation to remain high, and it's not due to strong consumer spending. They're saying the consumer in Europe is weak. Why? Because they're going for a cost of living crisis. They can't afford their energy bills, and now you can have interest rates going up at the same time. So people's mortgages, credit cards, student loans, car loan payments, they're all going to rise at the same time, as they can't even afford the energy bills. That's going to cause Europe to go into a deep recession because people's spending is going to be reduced dramatically. That's why the stock markets are falling, and that's why investors don't want to be in Europe, because interest rates can't get risen to bring down this inflation with oil and gas prices, because it's being driven by Russia. The central bank can't control what Russia does, so they're in a very difficult situation. So if you look at where inflation is now, 9.1%. If you look at the interest rate on a 10-year government bond in Europe, when we look at the German bond, which is the safest security you can buy in Europe, when you adjust that for inflation, currently you're losing 2.76% for every euro you get back in interest on that bond you purchased. But remember, inflation in Europe is going to keep going higher. Okay, so the inflation adjusted interest rate is turning negative. In the United States, it's a different situation. US inflation is now coming down. It peaked at 9.1%, and it's coming down because Europe, the United States, is a natural gas exporter. They're now actually shipping gas to Europe, trying to help Europe. So when the US Central Bank is going to be raising rates, they can bring down the demand quicker than the European Central Bank can. That's why investors are expecting core inflation now to keep going lower. Look, you can see it was at 6.5%. It's now gone down to 5.9%. So inflation in the US is slowing at the same time as the US Central Bank is raising rates. They're going to raise rates this month to 3%, November to 3.5%. It's going to go up to 4.5% by next year. And the Federal Reserve has told the markets we're going to keep rates higher for longer, and we're not going to bring them down until inflation is back towards our 2% target. So when you're looking at that, imagine interest rates in the US at 4.5%. Then as inflation becomes lower and continues to go to the downside, then the inflation adjusted interest rate is going to be turning more and more positive in the United States, because inflation will be going lower, but the interest rate will be remaining high, and it will come into equilibrium. Basically meaning investors that buy US bonds will keep their interest, the value, of the purchasing power of dollars that they're getting back in interest. That's why if you look at the difference in interest rates between Europe and the US, the exchange rate always follows this difference. So here we can look at the 10-year European bond, the US European bond, and this is just the interest rate on the bond. You can look at the difference, which is the European rate minus the US rate. Anything below zero means the US pays a premium interest rate over the United States. So look, we've been below zero since 2013. And look, as the blue line goes lower, the orange line, which is the exchange rate, follows. So you see? And as soon as it goes up in Europe's favor, the euro strengthens. And as soon as it goes down in the US dollar's favor again, the euro weakens against the dollar. And as soon as it goes up again in euro's favor, the euro strengthens. And when it goes down in the dollar's favor, the euro weakens. So look, right now, the premium interest rate is moving back in the US dollar's favor. Look, since all the way up here, it's been going lower in the dollar's favor. That is explaining why euro USD continues to trade to the downside. So until Europe can somehow get more gas into their country, bring down inflation as interest rates go up, then the euro is going to remain on the back foot. That's why we've been selling the euro. We've got a really nice technical trend line here at this moment in time, and we've been shorting the currency. They're saying it's going to go down to around 0.97 down here. And if you go on a monthly chart, you can see that it is a key support level that has held the markets in the past. So look, going back to 1989, you can see there's a lot of price action around this level in history. So this is where the markets are looking at a key level for the currency pair. For the pound, it's the same situation. The UK is in a very bad situation. They're saying UK inflation may hit 20% by next year. So again, look, the interest rate differential, same calculation is done by looking at UK bonds relative to US bonds, and the exchange rate is in orange. And look, the difference in the bond yields, meaning the interest rates, moves the currency pair. Look, they literally move with each other. Okay, and the reason being, if you're a European investor, if you're a UK investor, and you're seeing that the bonds sold in the UK or Europe are not protecting you from inflation, but the US bonds are looking more attractive, where do you think investors are going to go? They're going to go into the dollar to buy US bonds, and that is why the dollar is so strong against the pound. Growth differentials are more favorable in the United States, and so are interest rates. This is exactly why the US dollar is so bullish against the yen. Look, up 24% this year, and it's still moving higher. Why? Because Japan, number one, doesn't have an inflation problem. They've had a deflation problem for over 30 years. As you can clearly see, Japan is not having an inflation problem right now. It's just got to 2%. This is the first time it's been there for years. And if you look over the next 2 years, they're expecting inflation to go lower. This is why the Japanese central bank governor is saying, we're not raising rates, because why would I raise rates when next year it's probably going to go back below our target? That's why interest rates are remaining negative in Japan, which means if you borrow money to the government, bonds, you're not going to get any interest. It's 0.23%. Compare that to the US paying a premium of 3.11%. Big difference in interest rates, okay? That's what's dragging up USD JPY. And if you look through our history, guys, you can see there's a really good correlation between the US bond minus the Japanese bond. So anything in this example above zero means the US is paying a premium because the US is the base currency. And look, when it goes up, the dollar shoots up against the yen. And when it starts to narrow, the US dollar weakens against the yen. As soon as it takes off again, the dollar strengthens against the yen. Look, it's like a mirror image. They follow each other. Because basically, just look at it like this. If you're an insurance company, a pension fund in Japan, you want to invest your money somewhere around the world and buy government bonds because you don't want to invest in stocks, too risky. Don't want to invest in crypto, too risky. Don't want to invest in commodities, too risky. Buy government bonds, guaranteed to get your money back, plus some interest. So you're going to be looking around the world thinking, who's got the highest amount of interest rates with the least amount of risk? Right now, it's the United States, because Japan's paying you no interest. And by the way, Japan is the biggest debt holder of US treasuries. The biggest holder of US debt. Japan, number one debt holder of US debt in the world. So when you're seeing interest rates going up in the US, paying a better premium rate than Japan, what does the Japan insurance companies, pension funds do? They sell yen, buy dollars, move into the currency pair. And this currency pair, they're saying, is going to keep moving higher until that interest rate differential narrows, or when the Fed pivots towards cutting interest rates. But at this moment in time, look, you can see the 10-year US bond yield is just going up. It's not going down, it's going up, because the Fed is saying we're going to keep raising rates until inflation comes down. And inflation right now is looking sticky. So they're going to keep rates higher for longer, okay? That's why the dollar is getting so strong against the yen. So we got a major level coming up here around 145. This is a key level in history. You can see around here, look, it bounced off this level back in 1998. And you can see there's more price action around this level going back to 1987. So look, it hasn't been at these levels for a very, very long time. This is why they're saying 145 is a key level to look out for. If we break that level convincingly, obviously we can buy the currency pair. But if the Bank of Japan shifts its policy to try to weaken the currency, because a weaker yen makes the inflation problem in Japan maybe get a bit out of control, then maybe we could see the currency pair start to come to the downside. But I expect a lot of price action around 145. So I wouldn't really be buying around that level, because you could get a bit dangerous to get in at that price. All right, guys. And when we're looking at the pound against the dollar, they're saying this is the lowest level it's been since 2016, since the referendum. Look, we can see back here. This is the lowest it's gone below that level. And if you go back in history, hasn't been back down to this level against the pound since 1985. They're saying the pound could potentially hit parity against the dollar. That would be basically meaning £1 buys $1. That would be unheard of in history. So let's see what happens. Maybe, maybe not. Okay, so we're now at unprecedented levels, so you need to be careful about whether the inflation problem in the UK does get worse, or if for any situation it gets better, you could see a short squeeze where the pound jumps quickly because everyone's so short the pound and people jump out of the trade at the same time, and that would mean they're selling dollars back into pounds and could quickly push up the exchange rate. But as an example, Aussie dollar US dollar continues to go to the downside since April. And why is this? And it's all down to Australia's iron ore prices tumbling since April. So you can see iron ore price highlighted in red because iron ore is the biggest export for Australia, and it's created to use steel in construction. And look, when the iron ore price is going up, the Aussie dollar US dollar exchange rate moves higher. Why? Because iron ore is priced in dollars. So as the iron ore demand goes up, China is the biggest consumer of iron ore, and then when they're buying iron ore from Australia, they have to sell Chinese yuan into US dollars, and they sell US dollars into Aussie dollars to buy iron ore. And that's why when the iron ore price is going up, the Aussie dollar goes up. When the iron ore price is going down, the Aussie dollar goes down. And look, there's a very strong correlation between the two. And you can see since April, it's been falling, and that's why the exchange rate has been falling. And I'll tell you why it's been falling, because if you look at the Chinese data since April, manufacturing and services PMI went below 50, indicating contraction in the manufacturing sector and in the services sector. Basically telling you companies that manufacture goods are going through negative earnings, so are services going through negative earnings. So there's only two types of companies. You can either manufacture a good, sell a service, they're both turning negative, meaning that the demand for companies for iron ore to manufacture goods for buildings is going to go lower, meaning the demand for iron ore drops. And that's why in April, when it went below 50 on both indicators, that's why you automatically saw the Aussie dollar weaken against the US dollar, because the leading economic indicators were predicting a sharp slowdown in Chinese growth. And we know why, because China's still doing lockdowns. They've got this zero policy for COVID. Hasn't been working. Why they're continuing to do it, we do not know. But there is something to note. Remember, every time there's a recession, the iron ore price gets smashed dramatically. So if we look here, 2008, big decline. 2020, big decline in the iron ore price. Okay, so what we want to see here is, look, 2020, 21% decline in the Aussie dollar during COVID. And then if you look at 2008, 37% decline, and the recession before that in 2000, 28% decline. So every time there's drops in price, the iron ore price tumbles and the Aussie dollar weakens. So we need to keep that in mind to see what happens. Okay, is there going to be a deep recession globally? Maybe. And then Aussie dollar, New Zealand dollar, US dollar has also been going to the downside since April, because Australia and China is New Zealand's key trading partners. So automatically, if China goes through problems, Australia goes through problems, and then as a byproduct, New Zealand goes through problems because it's relying on trade with China and Australia. That's why the New Zealand dollar is weaker at exactly the same time. Then we can look at like emerging market currencies like the US dollar against the South African rand. Dollar since April up 20%, because that's when the Federal Reserve started raising rates around March, April times. So the interest rates, as they go up in the US, it causes a lot of emerging market currencies to struggle because they borrow a lot of dollars. They borrow a lot of money in dollars, and as the US dollar value goes up because interest rates are going up in the US, it means businesses that have borrowed dollars have higher interest payments. And then as the currency strengthens against South African rand, then their interest payments become more expensive because their currency buys less dollars. That's why, as an example, if I show you back in 2020 COVID, that's why you get big moves in the exchange rate against the currency, 40% in 2020 when that move happened. And if we go back and look in 2008, 73%. So if there is a crisis coming, and if the US Central Bank can't get inflation down quick enough, if it remains sticky and then the US goes into a deep recession, you know what's going to happen. The South African rand's going to get plummeted in the markets very aggressively. So it's really important to understand interest rates drive currencies. The bond yields are really important to look at. So this is the fundamentals driving the dollar at this moment in time. And moving forward, this is what is going to be the key to trade the dollar. Where are US rates going? Can the Fed get inflation down? If it goes down slowly and the Fed keeps rates higher for longer, that makes the dollar even more attractive because the US interest rates are paying a better interest rate when adjusted for inflation relative to Europe, relative to the UK, and is damaging for countries like South Africa. And what happens with China, because that's going to have an effect on the South African rand. So guys, look, if you're not already in my free channel here on Telegram, you're more than welcome to come and join. A lot of daily updates on the markets, explaining in detail what's going on, a lot of videos, live training sessions, so on and so forth, helping people understand what's going on in the markets. And then we have access to my membership service where you can join on a 60-day free trial to follow my personal trades, get updates in the markets, or you can come and get access to my online courses in my website. As you know, it's a monthly membership package that you can inquire about. So I hope this video added value, guys. Thank you so much for watching. Please subscribe to my YouTube channel for where you've seen this video, and I hope I can add value to your trading. Thank you, guys. Okay guys, so I really hope you enjoyed that video. We had a look at what's happening in Europe with the euro. We had a look at the pound, the yen, Aussie, New Zealand dollar, South African rand, and I was just showing you just how important it is to understanding the fundamentals driving the markets primarily, because I'm not sure if you guys have been looking at the charts, but if you didn't understand what's going on, then that's probably why you're finding it difficult to really catch consistent trades, because you really don't even understand what is even happening for the currency to be moving in the first place. So it's so important just to get you into this rhythm of reading. I use Bloomberg every day. I read 10-15 articles a day just to understand the market sentiment, and then in the spreadsheets I was showing you, I'm updating data to understand how to build like trade ideas. And we have like a section in the spreadsheet where it literally spits out a trade idea based on interest rate differentials and where inflation is going, because that's literally what's going to drive a central bank to raise interest rates or not. Okay, so I was touching on the interest rate differentials. Where are interest rates going relative from one country to another country, because it attracts money into that country. The United States right now is paying a higher interest rate than Europe. So is it paying a higher interest rate than the UK, Japan, and you're seeing these big fundamental moves because investors are coming out of these countries and putting their money into dollars because they can get more interest when adjusted for inflation. So they're getting more money, and you can see that trend is really pushing the dollar up in value. And that's why I was trading these currency pairs in that direction this year. With my members, we was getting some trades. So really important, guys. I do have an online course if you want to learn how to implement this yourself, breaking down the fundamentals in a lot more detail. I've actually just finished updating my new Forex course, and it's just giving everything I've learned over the years to understand how to fundamentally trade the markets. All right, guys. So again, I hope you enjoyed the video. Thank you so much for coming over. You're welcome to come and join my Telegram channel. Just click on the link below, and there's also a WhatsApp number there if you want to get in contact with me personally. Just ask me any questions. But guys, I really hope you enjoyed the video. Thank you so much for watching, and I'll upload another video fairly soon. Thank you.